Leveraged funds are historically bearish, while smart money is at its most aggressively long. Look, if you're actively trading fixed income, this is exactly the kind of massive, structural divergence that should make the hairs on the back of your neck stand straight up. I mean, right now, we're watching panicked speculators basically dumping bonds at historically crowded levels, all while the institutional commercials are just quietly and methodically scooping them up.
Welcome to this tactical briefing on the Explainer. Today, we are locking right onto a super specific, heavily data-driven market call trader James Gavrity set up for the 30-year T-bond, looking at the July 19, 2026 data. We're going to strip away all the usual market noise and just focus purely on the mechanics of this trade. No fluff, just the raw positioning data, the seasonal tailwinds, and the exact levels you need on your radar.
Here's a quick look at how we're breaking it down today. First, the smart money trap. Then Gavrity's bullish COT signals, followed by a bearish reality check. After that, we'll hit seasonal racket phases and finally wrap it up with the tactical entry and targets.
All right, starting with part 1, the smart money trap.
Okay, let's dive into this and look at the absolute canyon between how these two groups are positioned. On one side, you've got the leveraged funds, the specs. They are deeply crowded, heavily short, sitting on a net short position of over 365,000 contracts. They are betting the farm that bond prices are going to keep tanking. But then, look at the other side. The commercials, your dealers, asset managers, the smart money, they are at their maximum net long position for the past quarter. They are out there aggressively buying every single dip.
To really wrap your head around how insanely lopsided this is, just look at this number, 0.28. That's the current leverage fund long to short ratio. So for every single long contract these speculators are holding, they've got nearly 4 short contracts piled up against it. It's a historically crowded extreme. When the boat leans this far to one side, well, even a tiny shift in momentum can set off an incredibly violent short covering rally, because all those trapped shorts suddenly have to scramble and buy back their positions just to stop the bleeding.
Moving right along to part 2, Gavrity's bullish COT signals.
Looking at this positioning breakdown, the verdict is flashing a very clear long, sitting at 62% bullish. You'll want to focus right on the bottom rows here. Check out that green commercial net row. Commercials added a massive 24,389 contracts to their long position in just a single week. Now compare that to the red large spec net row right beneath it, which is buried at a staggering negative 376,485. The smart money isn't just passively holding here, they are actively and aggressively surging into this market.
And this exact behavior creates what Larry Williams calls a classic buy-dip setup. For this to trigger, you need falling open interest combined with commercials adding to their longs. Well, in the latest week, total open interest actually fell by nearly 37,000 contracts. So think about it. If open interest is dropping but the commercials are buying, what does that actually mean? It means the smart money is absorbing the selling pressure, they're covering positions, and they're happily accumulating into the weakness. Historically speaking, that's a huge neon sign signaling an impending rally.
Now, what's really interesting about this is the Godfather Index reading. On a 13-week window, it is locked at a perfect 100. If you're not familiar, this index measures commercial positioning relative to its recent range. Hitting a perfect 100 means the smart money is literally the most aggressively long they have been in the entire last 13 weeks. It is a textbook contrarian buy signal, completely cementing that short-term bullish momentum.
Okay, time for part 3, the bearish reality check. Let's make sure we keep ourselves grounded here. I really want to anchor the bear case heavily on this specific number, 44. Because yeah, while that short-term 13-week index is a perfect 100, the 156-week index, which pans out to a much longer 3-year horizon, is sitting at just 44. Visually, this proves that on a macro, multi-year scale, we are definitely not at a structural extreme. This severely caps the multi-year contrarian conviction. So let's be totally clear, we are not calling a generational bottom here. This is strictly a tactical setup. Plus, we absolutely have to respect the price action. The 30-year bond is still in a confirmed intermediate downtrend, down 2.4% over the last 13 weeks. The market recently rolled over pretty hard and has completely failed to reclaim the June 22nd high of 114.16. In fact, if you look at the weekly closes, there's a really clear rejection from that level, which leaves us with some very sticky overhead resistance right around 113.50. And on top of that, we haven't seen any massive participation shock, a 25% rule open interest surge in the last 26 weeks, that would give us the confidence to make a high conviction directional call. The technical trend is still undeniably down.
Which brings us to Part 4, Seasonal Treasury Market Phases.
Historically, the bond market cycles through some very distinct periods of supply and demand. What Gavrity's strategy is doing right now is anticipating a critical transition. We're looking for the shift from those heavy summer supply headwinds, which naturally suppress prices, into a late summer institutional recovery bid.
Let's move to a timeline and see how this builds out. From June through August, we get hit with summer supply pressure. Basically, a super heavy Treasury auction calendar historically weighs down long bond prices. That's the bearish phase we are currently trying to slog our way out of. But as we transition into August and September, things shift. We historically see this flight to quality bid. Risk appetite tends to cool off in the broader markets, and institutional demand for Treasuries suddenly picks up. This creates a really powerful seasonal tailwind for the longs, which eventually hands the baton to the year-end duration extension in November and December. So the timing of Gavrity's COT signal, it aligns absolutely perfectly with this impending late summer bid.
All right, let's get down to business. Part 5, Tactical Entry and Targets.
I want to quote Gavrity's report directly here, because having the right mindset on this trade is crucial. He defines this as, quote, a conditional long with tight risk near 109.75 rather than a high-conviction all-in trade. Because of that weaker 56-week reading we talked about, and the fact that we're still in a downtrend, you absolutely cannot just blindly swing for the fences here. The true edge of this trade isn't some absolute certainty, it's the risk-to-reward asymmetry. Your downside is strictly capped, while the upside potential of catching a massive short covering squeeze, that is huge.
So, the crucial point is getting this battle plan locked down. If you're tracking this, mentally log these exact levels. Your entry zone is between 111.00 and 111.50, essentially buying into the current weakness near near-term support. Target 1, or T1, is sitting at 113.50, which is a prior swing high and a major point of resistance confluence. Target 2 stretches up to 114.16, aiming for that stubbornly elusive June 22nd high. And your absolute hard deck, the stop, is firmly placed at 109.75. That's tucked just above the 52-week low of 109.00, which gives the market just enough breathing room to make a minor undercut, flush out the weak hands, without actually invalidating the broader setup. It really is a beautifully asymmetric setup, defined by strict risk management. So as we walk into this late summer seasonal shift, the stage is completely set for a massive clash. Will the smart money trap spring shut on those deeply crowded leveraged funds, kicking off a violent short covering rally? Or will the persistent summer downtrend and supply pressure just crush the early bulls before the seasonal turn even happens? You're going to want to keep a very close eye on the 30-year T-bond open, watch those critical levels we laid out, and as always, trust the data over the narrative. Thanks for joining this briefing on The Explainer.